Okay, so we are going to be discussing about this specific question, which is basically the recent past examination paper of the ACCA. In fact, wait a bit. I think I have not been allotted the relevant paper, which I actually wanted. Yes, this one. This one. So it's basically SBR. I repeat, it's SBR. It's SBR December 2020 examination paper, which is actually in front of you. And I'll be using the ACCA CBE platform to answer this question, so that you know that how to actually handle this type of questions in the examination. Okay, for those of you who wish to have this question in the PDF format, you can probably download it from the ACCA website. This specific question you could probably download from the ACCA's website. Okay, so let's just start off. This is the question, the name of which is Flour Company. And what we would be doing is we would be actually using the actual ACCA examination software to attempt this question. So with respect to this, you could see that this is how the examinations are actually structured, that you come across this introductory area. Then there are these various type of exhibits which you can open up, and you could see there are these different types of exhibits which are available. Then there are these requirements for the questions. And then there is this word processing document where you could answer the word processing things. And then there is this spreadsheet package where you could answer the questions which require the spreadsheet type of an answer. So what we would do is that we would be going through this question, and we would keep on discussing about the different things which are there, which are actually examined in this question. I hope you people would have downloaded the question from the ACCA website. In case if you have not, kindly do it in case if you need a PDF copy of the question, so that you don't have any issues in handling it. Okay, so it says that at 30th June 2007, Sugar Company has investments in several associate companies, including Flour Company. So what do we have? We have got this sugar company, and this sugar company has got investment. This sugar company has got investment in Flour Company. And what actually happens is that on 1st July 2007, Sugar Company acquired additional shares in Flour Company and obtained control. So what I could do is that, since I have the option in the examination of using the scratch pad, so whatever the notes that I need to take, I can actually take the notes over here. So I've taken one of the notes, which is basically about this sugar company, that it has acquired this flour company's additional shares and obtained control. On 1st October, sugar company also acquired an associate butter company. So there is also a butter company that was acquired and it is actually an associate. So this is also an important piece of information, and what I'll do is that I will actually put it also here. Now the next thing is that it says the group is preparing the consolidated statement of cash flows for the year ended 30th June 2008. So what is the group up to? They're preparing the consolidated statement of cash flows for the year ended 30th June 2008. The following exhibits available on the left hand side of the screen provide information relevant to the question. So one of them is about acquisition of flour company, explains the purchase of shares. The asset acquisition and disposal provide details of the assets acquired and disposed of, and the group financial statement extracts, including the extract from the consolidated financials of so and so pension scheme, and the information should be used to answer the requirements. Now let's just see the requirements of the question. You could drag this window to see more clearly what the requirements of the question is. One of them is draft an explanatory note to the directors of sugar company addressing how the initial 40% investment. So what do you need to do? You need to discuss about how the initial 40% investment in flour company. So that is one thing, and the additional purchase of the equity shares should be accounted for in the consolidated financial, including the cash flows. Including the cash flows, that is what you have to do. Using the goodwill figure of this calculate the cash paid. Calculate the cash paid to acquire control of so and so, so and so. So there is another thing that you need to do, which is you need to calculate the cash paid to acquire control of flour company and include brief explanation of how that cash should be accounted for in consolidated cash flows. Second is using exhibits 1 and 2, prepare extracts of the cash flow generated from investing activities, financing activities, and the consolidated cash flow in the consolidated cash flow for the group. No explanations are required. Describe the impact, if any, that the defined benefit scheme will have on the consolidated statement of cash flows for the year ended so and so, so and so, assuming cash flow from operating activities are calculated by indirect method. So now let's just actually go about it. Let's try to go through these things and try to understand. So first of all, what I'll do is that I will actually be opening up this specific thing. So what did it say? It says, and this is exactly how you will get it in the exam. You can zoom it. It says a 40% shareholding in flour company was purchased several years ago at a cost of 10 million. This investment gave sugar company significant influence in flour company. So you had a 40% shareholding and at a cost of 10 million. So basically what could happen is that if I could just open up my scratch pad here. So I would say that we had a 40% investment in flour company, and that was basically some years ago at a cost of $10 million. Now what next is there? It says the consideration to acquire an additional 3 million shares in flour company on 1st July 7 was in two parts, in cash and a share for share exchange, when the market price of the sugar was $6 each. So what actually happens is that you've got this additional investment. Now, in flour company's individual, the net assets had increased by 12 million between the two acquisition dates. The carrying amount of the net assets at 31st July was this. The carrying amount of net assets were equal to fair values, except for the carrying amount of the net assets were equal to fair value except for land which had a fair value of 600,000 above carrying amount. So there was this something that you got to do, and you got to understand that this was the fair value adjustment. Okay, this copy is not working, so you got to do the copy using Control-C. Now what next is there? It says the sugar group values NCI at fair value and share price of flour was this share price should be used to value NCI at the date and to value the initial 40% equity interest. Goodwill was correctly calculated as this and has been correctly accounted for in the consolidated financial statement. Now what next is there with respect to the asset acquisition? Let's try to understand. It says including its purchase of additional investment in flour, which it correctly consolidated. There were no disposals or impairments of the intangible, but amortization of 3.5 million had been deducted from profit from operation. The only addition to the property, plant, and equipment was this. So this is another area. I'm not actually considering that area right now, because I would actually be, I repeat, because I would actually be uh, I would actually be doing only one part and not a lot, right? So if I talk about these requirements, the first one of them is draft an explanatory note to the directors of sugar company addressing how the initial investment in 40% in flour company and the additional purchase equity shares should be accounted for in the consolidated financials, including cash flow. And using the goodwill figure, calculate the cash paid to acquire the flour company and include brief calculations and so on, so on. So it's a 10-mark requirement. What you could do is that you could actually go onto the word processor, and you can even type down the requirement of the question also. Just because a lot of students, they are like that, we want to know that what is the requirement, and we need to see the requirement in front of us. So as a student, if you wish to see the requirement in front of you, so that is also one of the possibility, that you could just copy the requirement, you could just paste the requirement in the answer bar and make it bold, so that you know that this is actually the requirement of the question, and then you may start writing accordingly. So that is also something that you can do. So we have copied the requirement. We know now what the requirement is. And what we can now do is that we can actually plan out the question accordingly. So the first requirement is actually pertaining to this area. So this is something that we would have to cover up. This is something that we would have to do. So the requirement again is that you have to draft explanatory note to the directors of sugar company addressing how the initial investment in flour company and the additional purchase should be accounted for in the consolidated financial statement. Now, always do the question one by one, because if you are going to do all of the requirements at once, you won't be able to handle it. Yes, Kimia, this session is actually on the Scriber's YouTube channel. So in case if you wish to see, you can see, or you can check out the Scriber's YouTube channel for this session also. Okay. So basically, the original investment of 40% provides significant influence and should be accounted for as an associate in the consolidated financial statement. Being an associate, it should be presented as a single line item in the consolidated balance sheet and the consolidated SOCI up till the date of acquisition of additional 30% shareholding. Upon acquisition of additional 30% shareholding, sugar company is now able to exercise control over flour company. Therefore, flour company now becomes a subsidiary, and the flour company now becomes a subsidiary, and the flour company now becomes a subsidiary, and the goodwill is required to be calculated as at 1st July 2000 X7. In order to calculate the goodwill, a deemed disposal of the investment in associate is required to be ascertained. The existing goodwill shall be calculated using the consideration for acquisition to be used in the goodwill calculation shall be the fair value of the existing interest, which was the 40% shareholding, and the fair value of the additional consideration paid, including cash and shares. So basically, the first thing that you got to do with respect to it is that the existing investment that was basically a 30% and 40% investment that was originally recognized as an associate. The day when you have acquired additional 30% shareholding, so now you have got control over the subsidiary. And if you have now got the control over the subsidiary, control over this company, so this has now become your subsidiary. And if it has now become your subsidiary, that means you got to consolidate it. And for you to be able to consolidate it, you got to calculate the goodwill. And for the purposes of the calculation of the goodwill, the existing investment should be recorded at the fair value, and the additional adjustments need to be made. Is that okay? Okay, good. There are additional requirements for this question which are also required to be done. So we'll do them now. Now the next requirement is we have to calculate the cash paid to acquire the control of flour company. So I'm just gonna see if I can actually, let's say, if I say 345, I say 450, I say 540. I'm just putting in the numbers just like for my own purposes. I'm just copying it and I'm just trying to see if I could paste it on this specific window. So I cannot paste it properly. I can only paste the numbers, but I cannot paste the proper tabular format. So that means, for example, if I have to do the calculation, I should make sure that I do the calculation on this Word format only, and rather than doing the calculation on the Excel format. That is something that I would have to do. Now let's try to see these things. When you calculate the goodwill, you say fair value of the consideration or the cost of investment has to be like this. Then what happens is there is this non-controlling interest, and there is this fair value of net assets. Now let's just try to see what is going to happen. We're being told that it was purchased for 10 million. Okay, just leave it. The consideration to acquire an additional 3 million shares in Flour Company was in two parts, cash and a 1-for-2 share exchange when the market price of the sugar was $6 each. In Flour Company, the individual, the net assets had increased by 12 million. Between the carrying amount of net assets was this. 35,741. The carrying amount of net assets is basically 35,417 or 35,741. Okay, it's 35,741. And if I say the fair value adjustment, so we're going to talk and we're going to incorporate the fair value adjustments also. So there's this non-controlling interest, there's this cost of acquisition. Now, the carrying amount were equal to the fair values except for a land which had a fair value of 600,000 above the carrying amount. So the land had a fair value of 600,000 above the carrying amount. So what are you going to do? You're going to say this is actually going to be 600,000. Now what next is there? The sugar group values NCI at fair value and the share price of Flour Company was 3.8. The share price should be used to value NCI and to value the initial 40% equity interest in Flour Company. So if I could just see, I just need to see that what are the number of shares of Flour Company. Let's just try to see if we are being given this information somewhere. We are being given the group financial statement extracts. We just need to see if the Flour Company's detail are being provided somewhere or not. Can anyone please confirm that? Okay, consideration to acquire additional 3 million shares in Flour Company. So that means that this 30% is equivalent to 3 million. So that means the total number of shares are going to be the 3 million shares is equivalent to 30%. So hence X is equivalent to 100%. So resultingly X is gonna be 10 million shares. So basically what happens is that if you try to calculate, how exactly are we gonna calculate? We're gonna calculate it like this. We're gonna say cost of acquisition, the fair value of the existing interest. We are being told that you need to use the value of the shares of 3.8 to value the existing interest. So the existing interest in the company was what? 10 million multiply by 40% shares, and then this is going to be multiplied with what? 3.8. So you got to use the calculator over here. 15.2 million. Okay, Jehane, why have you done this 3.8 into 20,000 shares? Why have you done 3.8 into 20,000 shares? There are a total of, I repeat, there are a total of 10 million shares of the company. I repeat, there is a total of 10 million shares. No, that is for the group accounts. You don't have to take that. Remember, what have you acquired? You've acquired subsidiary. So you got to take subsidiaries net assets. You don't have to take the group's net assets. The group net assets are after consolidation. Yeah, good enough. Thank you. Now, let's move a bit forward and let's discuss further. So, basically, what next is there? The next situation is with respect to the cost of further acquisition. So we had this 15.2 million. So if I could say in terms of thousands, if I could say in terms of thousands, it's actually going to be 15,200. The additional cash paid is the balancing figure and the shares issued. What is the share acquisition, the consideration? It's basically one share for two share exchange when the market price of sugar company's share was 6. So we have given R one share for every 2 shares. So that means we have acquired what? 10 million multiply by 30% shares have you acquired, divided by 2, sorry, multiply by 1, divided by 2, multiply by 6. Okay, so it's actually going to be 9,000. And with respect to the non-controlling interest, the non-controlling interest is now left with 10 million into 30%, right? Because you have now acquired 40% was already there. You have acquired additional 30%. So they are left with 30% now, multiply by 3.8. So resultingly, what is actually going to happen? It's going to be 11,400. Now, if I say this is actually going to be the goodwill, it's actually going to be the goodwill. And what were we being told that the goodwill is what? The goodwill is 22,59,000. Okay. So basically, the fair value of net assets turns out to be how much? 35,741 plus 600 is 36,341. So basically, this specific area is going to be the balancing figure. So what is it going to be? Can somebody please calculate? Okay, so the balancing figure turns out to be just $3,000. Balancing figures turns out to be $3,000. You do understand that when we are working, we are actually working in the reverse order. So we actually do this different thing, which is basically we if something is being deducted, we add it up. If something is being added, we deduct it up. So resultingly 3,000 is the amount that you are getting. Now let's just try to understand this. That basically what happens is that based on the above calculation, cash paid for the acquisition of additional 30% shareholding is 3,000. So that is what is your answer going to be. So what I could just do is that I could just summarize it, and I could just conclude it, and I could just make you see it, that this is what I have done with respect to this specific answer. And for your help and for your understanding, I'm just going to extract a printout also, so that you do know that whatever I've done. Okay, just for the sake of making you people easy to understand, what I'll do is that I will just open up the PDF file which I have just extracted or exported, just to see, just to make sure, because I am unable to show you people the answer completely from there. So I can show you here. And okay, Mr. Edwin, I have not answered the question. Okay, Hanan, just wait a bit. Thank you for highlighting that we have still skipped one of the parts of the requirement. Just thank you for highlighting. I'll just do it. Edwin, but for the sake of identifying that how much cash has been paid, this is how it has to be done. Okay, I can share this answer with you people later on. But for the time being, let's just see. There was another requirement and a brief explanation as to how that cash should be accounted for in the consolidated financial statement of cash flows. Now, for the consolidated statement of cash flows, the cash paid for the acquisition is required to be presented as net cash in the investing activities. So I'm just going to see that when we acquired this company, there was actually this cash and cash equivalent. When we acquired this company, there was this cash and the cash equivalent. So what we need to do is that we need to talk about it, that the net cash to be shown under the investing activity will be 3,000 minus 1234 is equivalent to 1766. It's gonna be 1766. I repeat, so it's actually gonna be what? 1766. So 1766 is the net amount that you have to show. 1766 is the net amount that you have to show in the consolidated statement of cash flow. You would say why? Because when I am acquiring the subsidiary, I am paying $3,000, but I am actually getting a 1234 cash in return for the subsidiary's acquisition. Okay, so up till now, what we have done is we have gone through requirement A of the question. I repeat, up till now, what we have done is we have actually gone through requirement A of the question. Now, let's move a bit forward. Okay, you wanna take the picture of the answer? Okay, I'm just gonna zoom it out, zoom it in. Yeah, let me know when I can move forward. Okay, Hanan, there is no requirement to account for the 40%. Okay, let's just see. The original investment of 40% provides significant influence and should be accounted for as an associate. In the consolidated financials, being an associate, it should be presented as a single line item in the consolidated balance sheet and SOCI up till the date of acquisition of additional 30% shareholding. Try to understand something. What is the year end of your company? You're preparing financial statement for what year end? 30th June 2008. Okay. Now, there's one more thing which you can add up to this specific scenario, which is basically that the gain / loss on the deemed disposal of the investment in associate shall be as under. The cost of investment in the associate was 10 million or 10,000. The share of post acquisition reserves the share of post acquisition reserves is 40% multiplied by 10 million, right? You have this 10 million. How much was the 12 million? It had increased by 12 million, right? So the post acquisition, your reserves had increased by 12 million. So what you're going to do is that you're going to say this into 12,000. So this actually gives you 4,800. So the carrying amount of associate is 14,800. The fair value of the 40% investment on further acquisition is 15,200. So there's actually gonna be what? A gain on deemed disposal, and that is going to be 400. The above gain on the deemed disposal of the associate shall be recognized in P&L. So basically there are multiple aspects. First of all, we have talked about the dealing or the treatment of 40% investment. You could even write it down. The treatment of 40% investment. Then there is this additional share acquisition. Establishing cash paid. This is how you're going to actually answer the whole question. Okay, there is actually a question that in the exam it has to be done in 18 minutes. How can we manage it in 18 minutes? Now, two things. Number one point is that not every question is long. Not every question is time taking. Not every part of the question is time taking. There are few parts which is time taking. There are few parts which are easier to attempt. So if you invest more time in one part, you can save the time in the next part. So yes, it is challenging, but still it's not like that every specific part is going to require a lot of effort. It's not always like that. Yes, Mr. Ibrahim, how can I help you? Yeah, Mr. Ibrahim, how can I help you? Okay, so let's move on to the next requirement, which is says using exhibits 1 and 2, prepare extracts of the cash flows generated from investing activities and the financing activities in the consolidated statement of cash flows for the group for the year ended so and so so on. So all that you have to do is that you have to perform the calculation for the investing and for the financing activity. That is something that you have to do, and you got to use the exhibits 1 and 2. What do you need to do? You need to use the exhibits 1 and exhibit number 2. Now, it says, including its purchase of the additional investment in flour company, which it correctly consolidated from 1st July 7, the group also purchased various assets. What does it say? The group also purchased various assets. Also purchased various assets during the year. There were no disposals or impairments of intangible, but amortization of 3.5 million had been deducted from profit from operation. So there is an amortization. Now, what next is there? Okay, I wrongly highlighted it, so I would just remove the highlight. I just said to highlight this portion. I unfortunately highlighted the whole of it. Now let's try to understand. It says the only addition to property, plant, equipment during the year were as a result of the acquisition of flour company. The group disposed of some plant and machinery at loss on disposal of 2 million. So we had this, that there were no disposals or impairments of intangible during the year, but amortization of 3.5 million had been deducted from profit from operations. The only additions to property, plant, equipment during the year were as a result of the acquisition of flour company. The group disposed of some plant and machinery at a loss on disposal. It says sugar company purchased 25% equity interest in butter company for 5 million cash, which gave significant influence. Butter paid a dividend in the post-acquisition period, and sugar also received dividend from other associates. During the year, sugar did not pay any dividends. It says there were no acquisition of investments measured at fair value through P&L during the year, but there were disposals which had a carrying amount of 4 million. These were sold at a profit of this, which was included alongside fair value gains in investment income in the consolidated P&L. The investment income also includes dividends received from these investments and any fair value gains, so and so. In addition to the shares issued to purchase flour company, sugar company issued $1 ordinary shares for cash during the year ended, so and so, so and so. Now, what do we need to do? We need to see these financial statement extracts also. And we are required to prepare the consolidated statement of cash flow extracts from the investing activities and the financing activities. So what I am going to do is that I would actually take up this question on the spreadsheet. I would take up this question on the spreadsheet, and I would rather try to do the spreadsheet basis this specific question. I've copied the requirement just because so that I can understand. Now, if I could say investing activities, and if I could say the financing activities. There's this investing activity, there's this financing activity. Now, let's try to understand this. First of all, we had this. Always remember, it's always the cash that is being shown. So when you are acquiring this subsidiary, you're going to be showing the cash. The net cash paid for the acquisition of 30% shareholding in flour company. So if I could just prepare this in terms of thousands, I could say that the net cash is going to be what? We just did do the calculation, and that was 1766. 1766. It would actually be 1766. And you could do this basically, if you wish to give the reference, you can give the reference which is as per working 1, as per answer A. Now, let's move a bit forward and let's discuss further. When we talk about asset acquisition, it says there were no disposals or impairments of intangible, but amortization had been deducted. Okay. The only additions of property, plant, equipment were as a result of acquisition of flour company. The group disposed of some plant and machinery at a loss on disposal of 2 million. The depreciation deducted from the operation was this 10 million. So the disposal of assets. Sugar company purchased a 25% equity interest in butter company for 5 million cash, which gave them significant influence. Investment in butter company. And this actually gave you a cash investment of 5,000. Sugar also received dividends. I don't know what they are, but we'll just see them. It says there were no acquisitions, but there were disposals for an asset which had a carrying amount of 4 million. They were sold at a profit of 500,000, which was included alongside the fair value gains on investments in so and so, so and so. So there are actually going to be the dividends received, the disposal of financial asset at fair value through P&L is equivalent to 4 million plus 0.5 million. So this actually gives you 4,500 as an inflow. In addition to the shares issued to purchase flour company, sugar company issued some $1 ordinary shares. So we're going to look at it. Now let's just try to see the financial statements. You got to reconcile the intangibles. You got to reconcile the intangibles. So when I talk about the intangibles, I could say intangibles, I could say property, plant, equipment, I could say associates. I could say financial asset at fair value through P&L. Now, what actually happens is paste is special. One 15865. Then there is this 52,818, 23,194 and 6,000. So we have got these different type of assets. We have actually been able to identify the opening. We've been actually able to identify the opening. We just got to see their movement so that we could, I repeat, we got to see their movement so that we could have a better idea that how and what impact would they be having on the P&L. Now, what happens is that the subsidiary acquisition, there was this intangible asset of 6,781. There is this property, plant, equipment of 18,076. With respect to the other net current assets, we're going to talk about them. The cash and cash equivalents have already been accounted for. So that's what it was. Now, what else is there? Fair value adjustment, 600,000. Now the next one of them is there's this amortization of 3.5 million. Then what happens is there is an amortization of 3.5 million. The only addition to PPE during the year was as a result of acquisition of flour company. The group disposed of some plant and machinery at loss on disposal of 2 million. Depreciation deducted from the profit from operation was 10 million. So there was this depreciation which was 10,000. Then there is disposal which we don't know. There is a disposal which we don't know. Okay, what else is there? There is actually 25% equity interest in associate for 5 million cash. So there is a disposal of associate also. And the disposal of associate had a carrying amount of 14,800. There was this further acquisition of the associate, and that was 5,000. That was 5,000. There's this fair value through profit or loss, which we know is Okay. The acquisition should be 5,000 positive. Yes, Sayed. Thank you. Thank you for this. Okay, has to be a balancing figure. But before we go on for the balancing figure, we just need to incorporate the the closing figures from this financial statement. $33,456. I can see here. Then there is this 55,124. Then 26,328. And then 3,000. So what you can do is that you can apply the formula equals to this minus the sum of this. Can somebody please confirm if this is a correct calculation? Yeah, it's a correct calculation. So what I could simply do is that I could apply this formula here at all of these cells. So resultingly, what have I actually got? I've actually got that the intangibles are acquired, the PPE are disposed of, the associates are additionally acquired, or the investment in associates have increased, and there is this balancing figure of 1,000, which is the fair value through P&L. So okay, have they mentioned somewhere? Jane, have they mentioned somewhere that the intangible includes goodwill? Okay, this line. Okay, thank you. Because we are not able to find separately. So this line is indicative that the goodwill is included there. Now, with respect to the share capital and the share premium, this is what has happened. Now try to understand what exactly are we going to do. We're going to try to account for each one of them one by one. First of all, if I could just try to see that this is subsidiary acquisition. Why have we? Okay, this is subsidiary acquisition. So this acquisition was because of acquiring the subsidiary. This amortization is non-cash. This balancing figure 14,310. So investment in intangibles excluding goodwill has to be there, which has to be this minus 2259. Sorry. Equals to minus Okay, so there is actually an investment in the intangibles of 12051. The next one of them is the PPE has been disposed of at a carrying amount of 6370. And we know that it's being disposed of at a loss of 2 million. At a loss of 2 million. So what is actually going to happen is that the disposal of PPE 6370. Disposal of assets is actually going to be what? It will give you cash of 6370. It's actually going to be this minus 2000, which is the loss. So 4370 is the cash that you have received. 4370 is the cash that you have received. Why? Because you have disposed it off. You have disposed it off at a loss. Now, for this associate, how would we do the calculation? Try to understand. You would look at financial statement. You would say we have covered all these 3-4 things. We have actually taken hold of them. The investment income is 13891. The share of profit from associate is 15187. Now try to understand this. What is it? 15187. The dividends received from associate, which is 15181 minus this 12934. So 4500 is what actually is. It's actually the dividends that you've received. Sorry, it's 15187. It's 15187. Now what next is there? There is this 1000 as financial asset at fair value through P&L gain. This is 3891. Receipt of interest / dividend from financial asset at fair value through P&L. There's probably something that I have actually forgotten to write. I bet there's something that I've forgotten to write over here. What was it for? This 15865. We have written it for something. Can somebody please guide me? Okay, I think that was not for anything, but rather investment income from financial asset at fair value through P&L. We have got this at 3891 minus this gain of 1000. So this actually gives you 2891. I personally think that this is all about the investing activities. I don't think that there is another thing that we need to incorporate here further. So in case if you think that I've missed out anything, just let me know. But I think that this is sufficient enough. Kindly confirm to me if you think that I have missed out anything. Okay, thank you for highlighting. We got to deduct the 400, which is the gain. Yes, thank you. Thank you, Kemi. Thank you, Mustafa Abdullah. I'll sorry, this thank you for Safdar. What is your name? Sarmad. Sarmad, thank you. Kemi, thank you. Now you can see this, Mustafa Abdullah. Okay, I've got multiple people asking multiple questions. Jihan, I mean, can you explain generally how did you link between your working and the P&L informations given in the question? Okay, basically, you see, I know this thing that the investing activities is required to be done. So the way I did it was, you see, when I open up this spreadsheet window, I've given sufficient space that I can see this area. So I clicked on the relevant area, went through it, and I could just see that what are the cash items that need to be shown. Once I've shown them, like for example, if I identify something, let's say if I identified this specific thing, so I would directly go onto the spreadsheet, I would write down what I need to do. I'll go back to it again. I'll just see in case if I need to confirm anything else. Okay. Then this one, I kept on doing it. Once I did that, I had these financial statement. So now what I did was I said, okay, these are multiple assets. In general, we prepare T accounts. So over here, what I'm going to do is that I'm going to write down these items in a columnar format. And I'm just going to put in the opening values from here. I'm just going to put in the closing values, would incorporate all the adjustments that arise. So automatically I ended up getting this specific reconciliation. Okay, Mustafa Abdullah, this is the formula of the balancing figure. I've used this closing figure minus the sum of these all up till the balancing figure. Okay, Jihane, I think, I mean, that's the only reason for doing this session on the examiner platform, just to make sure that you don't get surprises in the exam. And I thought that if I do 2, 3, 4 questions, at least you will have some of an idea that how to handle this. That's why I'm doing it this way. Okay, Parth Gada, if I'm pronouncing your name correctly, please let me know if you are clear on what you are asking. Okay, Sarmad, you are saying there's a 500 gain on disposal of financial asset that is also included in the investment income. Okay, so there was this 400. What was this 400? We had some 400 also again. Okay, so there is additional 500 pertaining to the gain that also needs to be removed. Okay, how did I find out the dividend received? How did I find out? Okay, the question is still not completed. All that I did was I opened up the P&L. I know this is investment income. This is share of profit from associates. So what I did with respect to the associates is that I said, okay, this is 15187 is the total income received from associate, which is actually going to tell you that this is the amount by which associate has increased. But all that we can see is that associate is increased by this amount. So that means the deduction is because of the dividends that the associate has paid. The reduction is because of the dividends that the associate has paid. Okay, we are still not done. We are still left. We have just prepared investing activity. We need to prepare the financing activities also. So if you are going to prepare the financing activities, so with respect to financing activities, just look at the financial statement. One of them is basically issue of shares. The dividends paid to non-controlling interest. Okay, so how exactly are we going to do all this? I'll say this is capital account. This is other component of equity. This is non-controlling interest. I would simply say opening 20,000, 18,000, 12,914. I can see it here, so I can actually write down from here. Then what happens is acquisition of subsidiary. What did you do? You issued shares. How many? 10,000 multiply by 30% was reacquired, multiply by 1 divided by 2. So you acquired 1500 shares. What is the par value of each share? $1. So the OCI, which is actually going to be with respect to the premium, we had the cost of investment. It was 9,000 minus. You could see here, it was 9,000 the value of the shares that was issued. So basically, what is going to happen is that this is 7,500. Then what happens is that there was this NCI also that arised on the acquisition of subsidiary. How much was that NCI? That was 11,400. So 11,400 was there. Then what actually happens is that there was this share of profit. Wait a bit, please. I pressed the wrong button, I think. Okay, I unfortunately pressed the button of back, but fortunately it has saved my workings. Fortunately, it has saved my workings. I unfortunately pressed the button to go back. Anyways, sorry about it. So the acquisition of subsidiary led to NCI. How much was that? It was 11,400. Now, what happens is there is this share of profit. That is 9162. Then you will have this balancing figure. There is this closing balance. So when we have this closing balance, it's actually gonna be 23, 33,600, 30,132. So you need to have the balancing figure here, this minus the sum of these. Okay, so now the issue of shares for cash. When you talk about the issue of shares for cash, you would say this plus this. Then there is this dividends paid to non-controlling interest. So this is going to be the cash flows from financing activity. Is that okay to all? Okay, what is the acquisition of subsidiary formula? Okay, kindly check it. We said 10,000 or 10 million shares were acquired, of which 30% additional shares were acquired. So the additional 30% shares were issued like this. One share was issued for every 2 shares. And since the par value is 1, so 1500. Now the total value was 9,000, so 9,000 means 1500 is this 7,500. Now let me know if you all are okay with this. Yeah. Please let me know if you all are okay with this. Yeah, if anyone has got any queries. Okay, Salim, I can understand it's taking a bit of a time, but again, what can I do? Yeah, Hanan, unfortunately, a long question. And the second thing is that the use of the software is making it longer. Okay, here you see, this is what the financing activities is. This is where I have done the calculations for. Okay, how did I get 8100? I'll just open up the formula. It was this closing figure minus these opening sum. Okay, there is an error. Okay, you are right. There is an error. We have not incorporated the share of profit. We have not incorporated the share of profit over here. Wait. Okay. There is no mention of the profit earned during the year, right? Okay. Thank you. So we are correct now. So this is done. This is done. This is what is balancing figure. This needs to be incorporated. That's it. So basically we are done with this investing and the financing activities also. Now what's the last requirement to the question? The last requirement to the question is, it was a 16-mark requirement that we just did. Describe the impact, if any, that defined benefit pension scheme will have on the consolidated cash flow for the group for the ended so and so so and so, assuming cash flow from operating activities are calculated by using indirect method. So that is something that you have to do. You have to talk about this specific area, that this um, how this specific portion is going to be dealt with. I repeat, you got to talk that how specific this portion is going to be dealt with. So you've got 2-3 minutes. Try to establish what you can do with respect to it. Okay, so are you done? No, Mr. Ephraim, it's not finished yet. Sarmat Khalid, in operations, all non-cash items should be added back. So the service cost, net interest, net remeasurement should be added back. Only contribution to the planned asset should be included. Benefit will not affect the cash flow. Okay. Let me guide you with respect to this defined benefit plan or the defined contribution plan. Let me give you some of a guidance so that you can have a better understanding that how exactly are they going to be considered and how exactly are they going to have an impact on the entity's financial statements. Let me explain to you. Basically, what happens is that whenever you've got a defined benefit scheme or whatever that scheme is, so what actually happens is that um, with respect to the normal accounting under the P&L, there is basically the service cost which is recognized, and there is a net interest that is recognized, and then there is this other comprehensive income, and in the other comprehensive income there is this net remeasurement gain or loss which is recognized. That's how you do it. So I repeat, that's how you do it. P&L OCI. P&L OCI. Now, when it comes to the cash flow statements, what you do under the operating activities is that your operating activities under the indirect method just start off with the profit before tax, and then there is this adjustment for. So under this adjustment for, you add up the service cost, you add up the net interest expense, and after these working capital changes, and after the working capital changes, we actually say the contributions paid have to be deducted from here. I repeat, after the working capital changes, the contributions paid have to be deducted from here. The contributions paid have to be deducted from here. Is that okay? Now, yeah, it has to be after working capital changes when we say, when we actually present the interest paid, when we present the taxes paid, that's when we actually show it. So it's usually after the working capital changes that you show it. Now let's try to answer the question. It says sugar is the only entity of the group which operates a defined benefit scheme. Pension scheme obligation increased during the year from this to this. The movement represents the current service cost component, net interest component, and also the remeasurement component of the year. Sugar usually makes cash contributions into the scheme on an annual basis. Significant increase in pension obligations for the year ended was because the contributions to the scheme did not follow normal practice and were made instead in July 2008. Benefits paid during the year were 2 million in cash. Now, what is actually going to happen is that you could copy the requirement here. You could copy the requirement over here, and you could just try to incorporate this into the answers. Let's just try to see how exactly the things are going to be. So if I say describe the impact and all, so how exactly am I going to be accounting for it? I would say that in order to incorporate the effect of defined benefit scheme in the cash flow statement, the items recognized in the profit and loss account, that is service cost and net interest expense, are to be added back as they reflect non-cash transaction. Since no contributions have been paid into the scheme, therefore therefore no effect of the contribution is required to be made in the group cash flow statement. So this is how you're going to actually be dealing with it. This is quite simple. This is how you will be dealing with it. Here is the answer. This is the answer. Okay, at times what happens is that it's not just about the 2 marks and 4 points, or 4 marks, 2 points. It's about the technical aspect also, that also is important. So here the technical aspect was there. Okay, the benefits paid are not considered because the benefits paid are by the fund, not by the entity. We are accounting for the entity, not the fund. Okay, so we are done with this specific question, the name of which was sugar company, flour company, and that was basically about the question was actually about this consolidation, the consolidated cash flow. So we are done with this. Now let's move a bit forward and let's discuss further. Before that, just wait a bit, just let me more settings. You can also export your answers. You can also export your answers. So I can actually now share this answer with you people in the WhatsApp groups. So I'm done with this question number 1 now. You can take a short break of 5 minutes, and before we start off with this question number 2, so you may take a 5-minute break, and then we are going to start off with this question number 2, which is actually about this company, the name of which is Calibra company, which is actually about the revenue recognition plus this sale plus some ethical standards. So you may take a 5-minute short break. No, Hanan, unfortunately, no, that is not a possibility. Okay. Wahib, it's actually more and more practice, practice, and practice. That's it. More and more practice is going to make things easy for you. Okay. So let's just start discussing about the next question, which is about the company Calibra. It says Calibra operates in the property sector and has invested in the new technology of distributed ledgers, blockchain to trade and to support property transactions. The financial year end of Calibra is 31st December 2008. So the financial year end of Calibra is 31st December 2008. The following exhibits available on the left hand side provide information relevant to the question. Apartment blocks explain how the sale of apartment blocks is currently accounted for. So that's what the apartment blocks does. Chief accountant and Bodoni company describes the relationship between chief accountant and Bodoni, a customer of Calibra. The distributed ledger technology, which is also the blockchain, describes how Calibra has distributed ledger technology or the blockchain to trade property, and the chief accountant lacks knowledge of that technology. The information, this information should be used to answer the question with response option provided. So it's only the word processor where the response has to be provided. The spreadsheet isn't provided because there isn't anything that you need to actually do with respect to the spreadsheet in this specific scenario. Okay, the number one of them is the apartment blocks. A company builds apartment blocks which normally take 2 years to complete from the date of signing of the contract. So what happens is that it takes 2 years to complete. The title and the possession and therefore the control of the apartment blocks pass to the customer upon completion of the construction. Price which is payable on construction is 9.55 million. And next it says alternatively customers can pay 8.5 million cash on the day the contract is signed. It says the chief accountant has calculated that this represents an appropriate borrowing rate of 6% for Calibra, and Calibra immediately recognizes 8.5 million as revenue if customers pay when they sign the contract. Now what next is there? Chief accountant does not hold permanent employment of Calibra. He has applied for position on a permanent basis and is to be interviewed in the near future. Bodoni customer, a customer of Calibra, wanted to take advantage of the 8.5 million reduced price for an apartment block but was having problems with the cash flows. Chief accountant therefore allowed Bodoni to pay 8.5 million and to delay the payment until 1 month. After the contract was signed in return, Bodoni has agreed to provide a good employment reference. The chief accountant of Calibra was afraid that he might lose Bodoni company as a customer and referee if he did not agree to the delay in payment. So there is actually an ethical issue that is arising. It says Calibra has recently used distributed ledger to sell shares in a property to investors. These digitized transactions are only visible to the authorized parties. The chief accountant publicly supports this technology and is to manage the new system. However, he has private concerns over reliability of the due diligence carried out on the sale of property shares and potential violation of local regulations. It says directors of Calibra want to increase the number of transactions on the distributed ledger by offering digital shares in the whole of the entity's portfolio. Although the chief accountant has a very basic knowledge of distributed ledger, he has assured the directors he can facilitate this move. The project has been approved by the board despite the chief accountant's private reservations. The chief accountant has only recently qualified and wishes to be employed with Calibra on a permanent basis. Now let's try to understand what are the requirements to the question. The various requirements to the questions include what? Discuss how Calibra should have accounted for the sale of the apartments with IFRS 15 and IS 23. Provide the accounting entries that would be required to record the contractual sale of an apartment block on 1st January 8 at the discounted amount over the 2-year construction contract period. Discuss the way in which the chief accountant should have acted to ensure that he maintains ethical standards. This is a 10-mark requirement. So in total, this is a 20-mark question. Now let's try to have an understanding of this. First of all, there is this requirement A. I'll explain. Amna Mohsin, don't worry, I'll explain. Yeah, kindly try to do this first requirement of the question. You've got this in front of you. Yeah, are you done? Are you people done? Okay. Now, how exactly are we going to be accounting for it? Let's try to understand. Basically, you would say that the price which is payable on completion of each apartment is this. Alternatively, customers can pay this much on cash on the day that the contract is signed. Chief accountant has calculated that this represents an appropriate borrowing rate of 6% for Calibra. Now you see what happens is that what you need to do is that you need to try and understand that since the customer has paid the amount in advance, therefore there is a significant financing component involved as the project is being completed in 2 years time. So one thing is that the project is being completed in 2 years time. Normally the amount payable is 9.55 million, but here because of the timing difference, amount paid is 8.5 million. This 8.5 million shall initially be recognized as a contract liability. So the double entry is going to be cash debit, contract liability credit, which is going to be 8.5 million. 8.5 million. Now, over a period of time, there will be unwinding of discount, which is to be recorded as finance cost in general, but in the current situation, since the apartment blocks are necessarily taking a substantial period of time to get ready for use / sale, Therefore, it shall be classified as a qualifying asset. Therefore, it should be classified as a qualifying asset. And the unwinding of discount on the above liability shall be recorded as borrowing cost for the construction of asset. So at what date have we received the amount? It's basically 8,500 into 6%, 510. Closing liability, year 1. This is equivalent to 9,010. Then there is this finance cost at the rate of 6% is 540.6. So hence what happens is that at the end of year 1, the accounting journal shall be finance cost debit Do you get it? Kindly check it out and just confirm to me that you people are able to understand this. Yeah, please confirm to me that you all are okay with this. Yeah. And what would happen is that at the end of year 2, the accounting entry shall be as follows. Finance cost debit by 540. The unearned income is credited by 540. And then unearned income, which is also the contract liability, is to be debited by 9550, and the sales are required to be 9550. Or you could say that it has to be inventory. Yeah, kindly confirm that this is all okay. Yeah, is it done now? Oh, why credit unearned income? Yeah, because it's an unearned income right now. Or you could call it contract liability. Or you could call it contract liability. This is unearned income or contract liability. That's what you can tell it. That's what you can call it. Yeah, please let me know. Are you people all okay? So that I can move forward. Okay, let's move on to the, okay, your Carolyn, you're asking 8.5 is the present value of 9.55. You can say, but not necessary. Now, let's move on to the next part, which is basically the second requirement. Provide the accounting entries that would be required to record the contractual sale of an apartment block on 1st January at the discounted amount over the 2-year construction period. So we have already done it. So it's actually going to be what? This is going to be answer to part A and this is going to be answer to part B. So we have already done it. We have already done it. It's going to be answer to part A. It's going to be answer to part B. Okay. Now, it says discuss the way in which the chief accountant should have acted to ensure that he maintained ethical standards in dealing with the issues described in exhibit number 2 and 3. So let's try to read through it. Chief accountant does not hold. Chief accountant does not hold. Okay, let me actually obtain, copy this. Okay, does it say the chief accountant does not hold a permanent employment contract with Calibra? He has applied for a position on a permanent basis and is to be interviewed in the near future. Okay, so if I could just write down few things on my scratch pad with respect to the chief accountant, not permanently employed. The second thing is that Bodoni company, a customer wanted to take advantage of 8.5 million reduced price for an apartment block but was having problems with cash flows. Chief accountant therefore allowed Bodoni to pay 8.5 million and to delay payment until 1 month after the contract was signed. Unauthorized grant of the credit by chief accountant. The chief accountant therefore allowed Bodoni to pay 8.5 million after the contract was signed. In return, Bodoni agreed to provide a good employment reference. So what happens is that this Bodoni company, it actually agreed that it would provide a good employment reference letter. Now what next is there? The chief accountant was afraid he might lose Bodoni as a customer and referee if he did not agree to delay in payment. So that means this was something that was done in the intimidation. Now what next is there? Calibra has recently used distributed ledger technology to sell a shares in a property to investors. These digitized transactions are only visible to authorized parties. So okay, that's a new way of doing it. The chief accountant publicly supports this technology and is to manage the new system. However, he has private concerns over the reliability of the due diligence, etc., etc., etc. So that means there is actually a problem with respect to his integrity. He is not being honest and he is not being straightforward. He is not being honest, he is not being straightforward. Now let's just move a bit forward. It says, however, he has private concerns over the due diligence carried out on the sale of property shares and the potential violation of local regulation. Directors of Calibra want to increase number of transactions by offering digital shares in all of entity. Although chief accountant has a very basic knowledge, he assured directors he can facilitate this move. He has got limited knowledge, yet he has offered the directors that he's going to support move. Project has been approved by board despite chief accountant's private reservation. Chief accountant has only recently qualified and wishes to be employed with Calibra on a permanent basis. So now, if you just try to see the multiple things with respect to this chief accountant, I've actually listed down all these things. And what I would do is that I would actually create an answer out of it. I would create an answer out of it. So first of all, if we try to understand this, basically what happens is that there are few things that you need to understand. First of all, like whenever you are answering the questions, there's something that you need to keep in mind, and that is basically the fundamental ethical principles, which include integrity, so we have got these fundamental ethical principles. Then there are the ethical threats, which includes the self-interest threat, the self-review threat, the intimidation threat, the familiarity threat, and advocacy threat. So if you could look into this scenario, we have got integrity, we have got the professional competence and the due care. Just try to see what are the things that are applicable over here. So you've got integrity issue, you've got professional competence and due care issue, you have got the various ethical threats, including the self-interest, you've got intimidation threat, okay. So what you would do is that it says discuss the way in which chief accountant should have acted to ensure that he maintained ethical standard in dealing with the issues describes in exhibit number 2 and exhibit number 3. Now, the chief accountant's actions while at work during his temporary stay at Calibra have led to various ethical issues to be identified. Firstly, the chief accountant lacks integrity, evidenced by him accepting the new method of recording on the face, but actually this behavior is because management is this behavior is because the management wants the new system to be implemented and chief accountant wishes to secure his employment. Therefore, despite having personal reservations, he is insisting upon being satisfied and promoting the idea of implementation of new system. So there is one aspect that you will mention, that this is a chief accountant's lack of integrity which is being evidenced over here. This is chief accountant's lack of integrity which is being evidenced over here. That's one of the aspects. The second thing is that the chief accountant is also lacking in the professional competence, in that he has basic knowledge of the system which he has committed to implement, rather than the advanced knowledge which may be required in order to handle the system. The third one of them is that the granting of the credit is for the purposes of is for the purposes of his own interest of getting / securing a permanent job, and not for the benefit of the organization. As the customer has agreed to acted as a referee for him to be promoted onto the permanent job. So the chief accountant should not have committed the extended payment period on his own without consulting with the appropriate authority. Furthermore, he should accept and bring to the knowledge of management that he is not updated with the relevant for making the records. So he should not have accepted it, that he knows it. He should have reduced, he should have told them that no, he should not have extended the credit just to seek his own favors. He wants to seek his own favors. So resultingly, this is something that he should have done